Personal opinions, feelings, hopes, and beliefs about the stock market are usually wrong and often dangerous. Facts and markets, on the other hand, are seldom wrong. The whole secret to winning big in the stock market is not to be right all the time, but to lose the least amount possible when you're wrong. There are only two emotions in the market, hope and fear. The only problem is we hope when we should fear, and we fear when we should hope. When everybody is running around saying how great a stock is, everybody who can buy probably already has, and the only direction for the stock to go at that point is down. When it's obvious and exciting to everyone, it's too late. The moral of the story is, never argue with the market. Your health and peace of mind are always more important than any stock. It is one of the great paradoxes of the stock market that what seems too high usually goes higher, and what seems too low usually goes lower. The market has a simple way of whittling all excessive pride and overblown egos down to size. Be completely objective and recognize what the marketplace is telling you, rather than try to prove that the thing you said or did yesterday or 6 weeks ago was right. The fastest way to take a bath in the stock market or go broke is to try to prove that you are right and the market is wrong. 90% of the people in the stock market, professionals and amateurs alike, simply haven't done enough homework. Over-diversification is a hedge for ignorance. Purpose will provide you a reason to continue producing excellence in your work. Investors cash in small, easy-to-take profits and hold their losers. This tactic is exactly the opposite of correct investment procedure. Terrible investors will sell a stock with profit before they will sell one with a loss. The number one market leader is not the largest company or the one with the most recognized brand name. It's the one with the best quarterly and annual earnings growth, return on equity, profit margins, sales growth, and price action. Plot out your mistakes on charts, study them, and write some additional rules in order to correct your mistakes and the actions that cost you money. Remember, keep it simple. Investing is hard enough. Stick to the basic rules of ConSlim and don't complicate it by getting super tricky. Over time, you'll learn that only 1 or 2 out of every 10 stocks you buy will be truly outstanding and capable of doubling or tripling or more in value. Buying a stock without knowing when or why you should sell it is like buying a car with no brakes, or being in a boat with no life preservers, or taking flying lessons that teach you how to take off but not how to land. There is no reason any investor should ever in any bull market buy or sit with a poor performing stock. The market is bluntly telling you that that investment is a relatively poor or mediocre choice. When you appear to be right, always follow up. Learn to always sell stocks quickly when you have a small loss rather than waiting and hoping they'll come back. At least 50% of the whole game is the general market. Charts plus earnings will help you tell the best stocks in general markets from the weaker, riskier stocks and markets that you must avoid altogether. Success in a free country is simple. Get a job, get an education, and learn to save and invest wisely. Anyone can do it. You can do it. My philosophy is that all stocks are bad. There are no good stocks unless they go up in price. If they go down instead, you have to cut your losses fast. Letting losses run is the most serious mistake made by most investors. Do not buy stocks that are near their lows, but buy stocks that are coming out of broad bases and beginning to make new highs. If you own a portfolio of stocks, you must learn to sell the worst performers first and keep the best a little longer. The majority of unskilled investors stubbornly hold on to their losses when the losses are small and reasonable. They could get out cheaply, but being emotionally involved and human, they keep waiting and hoping until their loss gets much bigger and costs them dearly. Since the market tends to go in the opposite direction of what the majority of people think, the personal opinions you hear are almost always worthless. Facts and markets are far more reliable. The majority of unskilled investors stubbornly hold on to their losses when the losses are small and reasonable. They could get out cheaply, but being emotionally involved and human, they keep waiting and hoping until their loss gets much bigger and costs them dearly.